Greetings from 3Edge Asset Management, and welcome to another edition of the 3Edge Week in Review for the week of September 7th. I'm Fritz Folts, the Chief Investment Strategist here at 3Edge, and I'm pleased to be joined here once again today by Steve Cucchiaro, Chief Investment Officer and President of 3Edge Asset Management. This week, along with a brief update of the global capital markets, Steve and I will be digging into our 3Edge Week in Review mailbag in order to answer some questions that we have received from our clients and others who follow our firm. If you'd like to submit a question or suggest a future topic for one of our 3Edge Week in Review videos, simply submit your questions to us via email at weekinreview@3edgeam.com. So before we get to the mailbag, let's get caught up on the global capital markets. So we've turned the page now on the month of August in what was a summer basically unlike any other. We've celebrated the Labor Day holiday, and we've turned our calendars to the current month of September. Now, during the first few days of September, both the S&P 500 and the NASDAQ Composite continued their summer rally, both indices reaching new all-time highs in the first days of the month. However, later in that same week, equity markets came under selling pressure, and particularly U.S. equities, and specifically the mega cap technology companies. And since these mega cap stocks are, for the most part, U.S. companies, it was the U.S. markets that declined more than the ex-U.S. equity markets. And perhaps investors finally seem to be questioning the significantly stretched valuations, particularly of these tech stocks, after a lengthy rally through the spring and the summer months. Now, markets seem to stabilize a bit here, but this current week is one that has experienced some good degree of market volatility. There were a slew of narratives to explain the sell-off, including reports of activity in the options market from a Japanese conglomerate, SoftBank, doubts about the timeline for the potential vaccine, concerns about the upcoming presidential election, the lack of a stimulus package coming out of Washington, and even a technical stock market chart pattern called a hanging man candle chart, a variety of different explanations. And while it remains to be seen where the equity markets are headed from here, thus far in September provides a good example of how very difficult it is to predict when an overvalued market may eventually reverse course and what the catalyst or catalyst might be. And oftentimes a market reversal to the downside is triggered by a combination of catalysts that occur simultaneously. So with the update out of the way, let's turn to the 3Edge mailbag. Let's get Steve into this conversation. Steve, the first question is one that we've heard, frankly, many times since this rally began in the spring. It's certainly a question I've asked myself on more than one occasion. And the question is this: with yields on cash and bonds at historic low levels, sitting on the sidelines is frankly very painful. It feels as though investors have to be invested in equities in order to generate any reasonable return, although equities seem like a scary place to be, particularly on those days like we saw during that two-day sell-off at the end of the first week of September. So the question is, are equities the only game in town at this point, and what alternatives are there for investors to consider?
Well, Fritz, it is uncomfortable to sit in cash or treasuries when you earn a rate of return less than expected inflation. And that's true not just for cash, but for treasuries, all the way from treasury bills, 3-month treasury bills, all the way to 30-year treasury bonds, all below the rate of expected inflation. So it's not comfortable to be invested in something where you're losing your purchasing power as you go along. On the other hand, doesn't mean that equities are the only game in town. And there's a great variety within the equities to choose. So for instance, gold can often be a very good home for a place to put your money when interest rates are below the rate of expected inflation. And we've seen that in history, and we're seeing that now as we speak. Also, within the equity markets, the disparity between valuations, especially U.S. versus non-U.S. equities, are really extreme right now. So it's possible to be in equities without just being in overvalued equities.
Excellent. So this next question we've also received a bunch of times, and I guess I've asked myself this question as well, and it's about the upcoming U.S. presidential election. So we're less than 2 months away from the election, and it is definitely generating a great deal of angst and a great deal of uncertainty. Should investors actually consider repositioning their portfolios heading into the election?
I do think that the election poses some unusual risks to the market, but not necessarily what we read about in the paper. So our perspective is that over the last few years, we've had the most massive monetary and fiscal stimulus just thrown at the economy, thrown at the market, pre-election, doing everything possible to get the economy and the markets to behave as well as possible before the election. However, to do that, we had to take on record levels of debt. So in effect, we've been robbing the future, try to make the present better. So what I've been telling people is that regardless of the election outcome, we should at least anticipate a strong possibility of what I call an election hangover, meaning whatever the election outcome is, the amount of stimulus that it's taken to keep the markets and the economy going is not sustainable, cannot be contained. And because we're taking on all this debt, we're robbing from the future, that's going to lead to slower growth than otherwise might have been. It could lead to inflation if some of this printed money gets into the real economy, could lead to higher taxes to try to pay off the deficit, and it could lead to currency debasement if we just keep printing more and more money. So I think it's a good time to be cautious. And we've begun that process by pulling back what we think is the most overvalued market, equity market, which are US equities. And we've already pulled back to our minimum equity allocation. So that's in anticipation of some higher risk. We still own equities that are much more reasonably valued. And what we have to be cautious of is, will there be a downturn in the US market that's strong enough to pull the rest of the world down? Or will there be this dichotomy, which seems to be happening right now?
Excellent. Well, that's a perfect segue then into this next question, which is about Japanese equities. And recently, Warren Buffett made news when it was revealed that he was building positions in Japanese equities through, I believe it's through Japanese trading companies. Is that right?
Yes, that's right.
So Japanese equities have also moved to the top position in our three-edge investment research model in terms of projected risk-adjusted returns. So my question is, or the question that we've had from several others is, why is Buffett investing in Japan now? And how is his view of Japanese equities similar to the view from Three Edge? And even maybe perhaps how is it different?
So I think it's really important to point out that for years and years, Warren Buffett readily announced and admitted that he had a very strong US bias. So for him to have recently sold lots of his US stocks and then all of a sudden made a big buy in Japan is very remarkable. It shouldn't go unnoticed. It should wave a flag. And I do believe, without knowing directly, but I can make an intelligent guess, that he is seeing some of the very same valuation differentials that we're seeing in our models. To give you a hard example, the price to sales ratio, or if you take the value of all the US stocks and compare it to the value of all the sales revenue of those companies that make the stock market index, that ratio over long periods of time averages a little over 1. Sometimes a little higher, sometimes a little lower. Right now, valuations are so extreme that we just recently hit, at the end of August, a price to sales ratio of 2.59, way over average. At the same time, the price to sales ratio in Japan is below 1. This is an extreme disparity, and one either has to conclude that US stocks are highly overvalued and vulnerable to a correction, or Japanese stocks are highly undervalued and have a lot of upside from here, or some combination of both. So that's what I think was behind Buffett's move. And we're happy to see that because we've already been invested in Japanese stocks and our clients own Japanese stocks. But that is the main reason why, that based on valuation metrics, there's a large disparity that we think, rather than getting even wider, will start to narrow.
Excellent. Very good. Thank you for that. So that will do it for Steve, for us. And Steve and I will be back again next week with another edition of our Three Edge Week in Review. And again, if you'd like to submit any questions for us to cover in an upcoming episode, just send those along to us at weekinreview@3edgeam.com. Remember, all of our videos are available on our 3Edge YouTube channel. Feel free to subscribe to that channel in order to receive notifications as we release the videos, and always feel free to share these videos with anyone who you think might be interested. So on behalf of Steve and everyone at 3Edge, we urge everyone to remain focused on staying safe and healthy, particularly as we enter into the fall flu season. So Steve, thank you again for your valuable insight during this exceptional period.
Thank you, Fritz.
And thanks for listening.